Good afternoon. Happy Thursday. Happy fall. I'm Caleb, and most of you know me, Chief Product Officer here at Y Charts. But more importantly, I've got with me our returning guest and longtime friend, Charlie Bolello. So, Charlie, thanks for joining us again this month.
Awesome. Good to be with you.
Yeah. Anybody that doesn't know, Charlie's founder and CEO at Compound Capital Advisors, where you're in charge of everything from research, portfolio management, and especially content creation too, right, Charlie?
Yep.
And if you're not already checking out Charlie's blog and following him on Twitter, you should definitely do those things. Always great content coming out that way. And then, if I'm not mistaken, Charlie, you also have a relatively new YouTube channel, which is good to follow, right?
Yeah, absolutely. Do a weekly, at least a weekly show on there covering the most important charts and themes. So check that out if you're into videos instead of writing.
All right. And while we're talking about following things on YouTube, there will be a recording of this webinar, Suns around tomorrow. If you happen to watch the recording, that will be on our YouTube channel. And if you follow Y Charts and like Y Charts there on YouTube, you'll also get updates on our content. So follow Charlie, follow Y Charts, and you'll have all the great YouTube videos you can ever desire. But today we're going to talk about investing in a recession. So let's jump into the agenda here. We're going to talk about several things. Maybe the first question will be, are we in a recession? So we'll spend a little time there. We'll talk about bonds this year. I'll talk about what's going on in the housing market. The Fed is always a fun topic with Charlie. And then we'll also be talking about fear and why that's good. So we'll hit on a little maybe Halloween topic there at the end. But let's jump into the first topic. So I guess when we answer this first question about how to invest in a recession, is this something that we're already doing? Are we already investing in a recession? Is it a recession, Charlie?
Yeah, that's the big debate, and this chart here would suggest strongly that we probably are. There's something called a duck test you probably heard of, where if something looks like a duck, swims like a duck, quacks like a duck, then it's probably a duck. And if we look at this chart, we could see those red arrows are pointing to the periods in the US where we've seen two consecutive quarters or more of negative real GDP growth. And the last 10 times that we've seen that in the US was in a recession. And we've even had two periods where we didn't have consecutive negative quarters, where we had recessions as well, that happened in 2001 and back in 1960. So not every recession has this two consecutive quarters, but the last 10 times we've seen it, the US has been in a recession. And it's hard to argue that real economic growth has not pulled back this year. So that would be the argument, the strongest argument in favor.
So channel your, I guess, devil's advocate here and talk
Yeah.
about why we might not be in a recession.
So, what are people pushing back on? What's the one thing really missing? We have a number of indicators suggesting that the economy is weakening, and the big one that's not yet showing, or at least a red, warning signal just yet, is the labor market. The unemployment rate at 3.5% is back to pre-pandemic levels, which is awesome news, and the lowest we've seen since 1969. So if you look at those gray shaded areas there, what you tend to see during recessions, of course, is jobs decline and unemployment rate goes up. Now, there is some lag. Sometimes there's been a number of recessions where there's been a sizable lag, but I don't think we've seen anything like this before, where we're hitting lowest levels in 50 years in the midst of what appears to be, based on the other data, a recession. And what is the main reason for that? What's the pushback in terms of, well, there could be an economic slowdown, even though the labor market is holding up for now? I would point to this chart on the right here, and it's something we've talked about on prior webinars, but we never entered a recession in this kind of situation where you had the number of job openings at such a high level relative to the number of unemployed people. So there's just such a demand for labor still entering this year that even with an economic slowdown, and of course we've heard all of the reports of layoffs in big tech and in that space, but there's many industries still that are looking for workers, and I think that's been helpful in keeping that rate down. And then of course you have inflation, as we'll talk about in a little bit, a pretty big problem this year. And so people are coming back to work, coming back in the labor force. So I think by the time we're on our next webinar, you're going to see that chart on the right side move down, and likely the chart on the left start to move up. So the number of job openings is coming down pretty rapidly at this point, and while the number of unemployed people isn't moving up, you're going to see that spread start to normalize, and that has a lot of implications for other things. So that would be the explanation. But regardless, it's still a debate, which is interesting to me, given that first chart, the Federal Reserve still hasn't acknowledged, as we'll talk about, that we're in a recession, and the federal government, of course, and Janet Yellen are still disputing that fact, and they're pointing, of course, to the labor market charts. But a recession can only be called in hindsight. We have this organization, the National Bureau of Economic Research, that declares a recession, and they don't use any formula to determine that. So it's a combination of factors. They look at production, income, employment, and sales. They put that together and come up with the determination, but usually there's a long lag between the start of a recession and when they say you're in a recession. As we'll talk about, there's also a lag when the recession's already over, that they say it's over. So regardless of whether we're in a recession or not, what should an investor be thinking about during this period where people are debating things? That's what I think we should focus on and talk about.
Makes sense to me. And if I remember correctly, the last recession, which was during the early days of the pandemic, I think we actually were told we were in a recession after it was already over. Is that right?
Yeah, that's right. Yeah. So it wasn't very helpful at that point, for sure. And the stock market had already recovered substantially, as we'll talk about. Yeah. So that was, of course, a little bit unusual. It was the shortest recession in history, right? We had just that collapse when the economy shut down. And then that was the low point of the economy. And then technically when you're coming out of that, well, now you're in an expansion again. So a little bit of a unique situation. But yeah, the point is, by the time someone tells you that you're officially in it, you probably can't do anything from that from an investment standpoint. You got to do something well in advance, as we'll talk about.
All right. So it's been a rough year.
Yeah, you think?
It sure certainly depicts that. But talk us through, those kind of depressing numbers down there in the lower right-hand corner.
Yeah, I think the big takeaway, we've had stock market declines, of course, in the past, and stocks don't always go up despite what's happened in the last decade. It kind of feels like that, and I think that even became like a mantra, right? Stonks only go up during the mania last year, and what we're seeing this year is a return to reality, that risk is there even if you can't see it. And what's unique about this year is not the S&P 500 decline, which is, if the year ended today, it would be among the worst in history. It's that second column there that you see, the 10-year Treasury bond, which if the year ended today would be by far the worst in history for the bond market. And so the combination of those two together is something we haven't seen. So I highlighted the other years in which the S&P and bonds were down at the same time together, and that's only happened a handful of times: 31, 41, 69, and 2018 just barely, with the 10-year just fractionally negative. But this year will be the first time in history that both stocks and bonds are down over 10% in a calendar year. So a 60-40 portfolio down over 20% so far this year. That would be the second worst in history after 1931. And you probably know what was going on in 1931. That was in the midst of the Great Depression, not really a great time for the economy. So what is this leading many investors to do? They're panicking. I haven't seen this in a long time, and they're selling on that panic after the fact. So last year, when we had a webinar talking about prudence and talking about the rolling manias that were going on, that would have been the time to readjust your portfolio. Now you're selling after the fact and panicking. And that in the long term doesn't tend to be a good strategy because the markets tend to come back. And at the time of peak pessimism and peak panic, tends to be a better time, as we'll talk about later, to get into the market, not get out. So if instead of panicking, if panicking isn't a good idea, what should investors be thinking about? And here's a few things that I would point out during recessions or periods that look like recessions.
And one thing, I guess on that prior table too, anytime that last column where that 60-40 was down double digits, there were some encouraging numbers that followed that immediately, right? Which
for sure. And
right
no prediction that that's going to happen next year. But yeah, the big down years tend to be followed by big up years on average. Right?
In
the market tends to go up most years, right? So that's a factor as well. But you just have volatility tends to cluster. So when you have big downs, you tend to be followed by big ups. Not always, but often.
Yeah, Charlie, real quick, one of the questions that came in, looking at that, and maybe I'll flip back real quick to this chart. Yeah. Any economic similarities that showed up in your research across some of those years that are highlighted yellow?
I don't think so particularly. Like the Depression was very different than this because of the deflationary aspect, and so you'd had bonds were slightly down in 1931, but during that period interest rates fell. In the early 1940s, you did have some inflation during World War II, but hopefully we're not going into World War III, and that won't be a similarity. 1969, yeah, you were just entering the inflationary period of the 1970s. But in terms of like bear markets, the most similarity, as we talked about in the last webinar, would be the 73, 74 period and the early 1980s period for bear markets. And you don't even see it on a calendar year basis here because interest rates were so high back then that even though they rose in the short term, your cushion was so high, you're earning so much on that coupon. So, and we'll talk about that in the bond section. So really those two bear markets from the standpoint of comparing today were similar, but you just didn't have that same pain on the bond side because the starting yields were so much higher heading into that inflationary period. And what makes this year so unique was we're starting at super high valuations for equities and super low yields for bonds, which was kind of the perfect storm.
Sure. All right, I'll let you get back on track.
Yeah, so what should investors be thinking? Number one, recessions happen. Right? You see all those gray bars there. Since going back to 1871, there's been 30 recessions in the U.S. once every 5 years on average. If you look on the let's say the right half of that chart, what you'll notice is the U.S. economy has become much more resilient and diversified. So we used to have recessions, every 2 years or so, and now it's the expansions are going longer and longer. And before the 2020 recession, it was actually the longest expansion in history. So recessions happen. You should expect them to happen. And without a recession, you wouldn't have the upside because part of the reason you're getting that equity risk premium, part of the reason equities over the long run deliver a higher return than bonds or cash is because there's uncertainty. There's that risk of an economic contraction, which is going to hit earnings. And you don't know how deep that's going to be or how long it's going to last. And that's one of the reasons why equities give you that return, which 6.9% annualized after adjusting for inflation has been by far the best asset class over the last 100 years plus, right? So recessions happen. If you can't stomach that as an investor, you can't invest in equities because that is, you can't have the upside without the downside. And that's just part of the game. And so your next question would be, okay, recessions happen, but we tend to see big drawdowns in the stock market during recessions. So why not get out of the market when a recession starts and get back in after it ends, right? It's a reasonable question. We'd all love to do that. The problem is, and I tested the data going back in time and saying, well, what if you were the world's best economist and you could time each and every recession, you could get out of the stock market and go into treasury bills at the start of a recession and then get back into the stock market at the end of a recession, how would you have fared versus doing nothing, right? Just to buy and hold. And if we look back and we include the depression, which is that first row there, you would have outperformed a little bit. You would have been 10.7% versus a 9.7% buy and hold. But all of that outperformance was due to getting out before that depression because it was such a big stock market decline. It was 80% and it lasted so long. And if we exclude the depression in that right side, you actually would have underperformed buy and hold. And the other point is that the world's best economist doesn't exist, right? Nobody coming into this year was talking about a recession, not many anyway. And so more likely, if you're going to get the timing close, it's not going to be exact. So what I put two other scenarios in there. What if you sold out a year before the start of a recession and bought back after a year after it ended, or sold 6 months after the start of a recession and bought back after a year after it ended? How would you have fared? And both of those scenarios would have been worse than buy and hold. And the important point here also, this table doesn't include transaction costs and slippage and fees and all of that. And if you were buying and selling back in the 1920s and 30s, the cost was not zero like it is today. It was a pretty high transaction cost. So if we included that, even if you're the world's best economist, you would have been done worse than a buy and hold. And the question is, well, why is that? And the answer is simple. The stock market's not the economy. The stock market is forward-looking. It often bottoms before the end of a recession, and it often peaks before the start of a recession. So knowing when a recession is going to happen might help you a little bit if you got the timing exactly perfect, but nobody can. And once you're in that recession, you can't wait for the end of it. You have to buy before it because the stock market's likely to move up, as we'll talk about, well in advance of that good news. Yeah.
Speaking of which.
Yeah. So do you remember, Caleb, back in October 2008, Buffett put out this op-ed. He rarely talks about market timing. He's pretty much against that if you hear him speak over time. But he actually wrote an op-ed that was published in the newspapers saying, "Buy American, I am." And this was back in October 2008 during the depths of the crisis. The market was probably down close to 50% at that point from its peak. There was nothing but bad news, and he had a line in there I think is instructive for investors, which is, if you wait for the robin, spring will be over. And what he meant by that was simply that by the time the news gets better, by the time people are talking about how good the economy is doing again, the cheaper valuations that you get during a recession, during a stock market decline, will be gone, right? And this table kind of illustrates that. I went back and looked at the NBER, and they have on their website announcement dates going back to 1980 of when they said a recession would end. And I compared that to how much the S&P advanced from its low to that date when the recession ended. As you can see, on average, over these past 6 recessions, it was a 60% increase on average. And you had mentioned the 2021 there. They didn't announce the end of it until July 2021. And by then, the S&P was already up 94% from its low in March of 2020. So you can't wait for the robins. You can't wait for the news to get better again if you want to take advantage of cheaper valuations.
And this reminds me of a picture we've all seen, right, which depicts the difference in performance of a portfolio that's been invested consistently versus missing like the 5 or 10 best market days, which just has monumental impacts on your long-term returns, right?
Yeah, for sure. I mean, if you take away if you take away the initial stages off of the bottom, if you miss that part by getting out in terms of panicking out, it might be right for a period of time, but if you don't get that timing right coming back in, the market usually doesn't bottom and then just languish, right? It languished for a while. It tends to move up fiercely when you have that better news start to occur. The market's looking ahead to that, and that's what we saw in 2020. It's what we saw in March 2009, and for a period after that, for good reason, the news is still bad, and people are doubting that move, and they're saying, "Well, this is too much, it's too fast," and only in hindsight do you know that it wasn't, right?
Right. All right. Step four.
Yeah. So last point, I think it's tempting during a bear market to kind of look at the best performing asset class, look at hedging after the fact, and saying, forget this diversification nonsense. I should be concentrated in that area that's doing well. And during the 2020 COVID crash, that area was volatility. So people were piling into volatility products because we saw the highest VIX close in history, and they were fighting that last war. So what we saw from there is a mean reversion in volatility. It came back down. Of course, no one believed it would. And if we look at a table on the right side there, what typically happens during these periods of high volatility? Well, the market tends to rebound. There's a mean reversion in both directions. And when the rubber band is stretched so much in one direction, it tends to snap back in the other direction. So every bear market's different. This bear market, the VIX, is in the 30s, which is high. It's in the top 10% of VIX levels, and you tend to see better returns over the next few years following those levels. But it's not the same, I think, concern as it was in 2020 during this bear market. Really, the standout has been commodities and crude oil, as we talked about in the last webinar. And what I said back then is, be careful piling into here. Crude oil, I think back that was, at its highest level since 2008. And you're hearing nothing but things that it's going to go higher. And the temptation is to jump on that because that's working and doing well. Not to say that it shouldn't be a part of your portfolio, having a commodities basket, but to go all in after the fact is fighting the last war. So try to stick with your plan, maintain a diversified portfolio. If you're going to do a move, do it on the margin, and try not to be reactive, but proactive in your portfolio.
Charlie, is this problem, I guess, more pronounced now than in prior recessions or prior times in history, just because getting access to these types of investments is so much more readily available? I mean, you can get an ETF now that tracks the VIX, right? That wasn't something you could have done, I don't think, back in the '08 financial crisis.
Yeah, for sure. I think you can access anything, and I get part of that is good for investors. They have options. They can there's certainly fees have come down because of that, and there's a lot of good things about choice, but the bad things is that there's more opportunity to chase and that herd behavior, right? And so we've seen many instances of this in recent years with this proliferation of ETFs and futures and other products where short-term volatility has really risen because of that. I think you just see more money flowing in and out very quickly because of access to the problem. And if you're a long-term investor, that doesn't really affect you or matter. It may even be a good thing because there's more people jumping in and out. There's more liquidity. Spreads are lower, and like I said, fees are lower on these products. They've gone down to zero in most of the the major equity and bond ETFs, and so that's a good thing if you're a buy and holder. But if you're not, there's the opportunity to trade more, which doesn't tend to be a good thing for most people.
All right. So we've got the playbook, right? So be prepared to weather the storm, stay invested. Don't stop investing when the market's hitting lows or things are starting to feel pretty painful, and don't get too distracted by the shiny objects that might be protecting against that downside. So yep. I guess we'll move on and talk about the worst year in bonds. Before we do, I did forget to mention something kind of early on, which is because of all the great content that happens in these webinars, we were able to start offering CE credits for these. So anybody that is looking to take us up on that, you should be getting a form in your email, I think tomorrow, and you can fill that out, and that way you can get your CE credit for an hour for joining the webinar today. And now we can move on. So you talked about, this a little bit in that chart, which showed the 60-40 portfolio, the bond market and the stock market, and how it's been a rough year for bonds, but let's go into it in a little bit more detail.
Yeah. So this is the Bloomberg Ag. I think before we were just looking at the 10-year, which we have more history on, and 15% is decline this year in the Bloomberg Ag is 5x higher than the worst prior year for bonds, which is in 1994. So people used to talk about 94 and the battle scars from 94. Well, this year is going to be remembered for a long time in the bond market. And what's really different about it, as we talked about, is that right chart there, which is showing you drawdowns for the S&P and the bond index. And if we look back in history here, going back to 76, what we see is most of the time when the stock market's down big, bonds are not going down hard. And this doesn't show their yearly return, but if we went back and looked at it, it would be positive in most of the biggest down years, right, going back during this time period. And so what's different about today is that you have the drawdown in both stocks and bonds at the same time. And we know the reason for that. We talked about that the last webinar, but we'll say it again. You have the primary reason for the stock market decline is rising interest rates and rising inflation. And so when you have those two together, that's when you have the problem of stocks and bonds going down together. And we saw that briefly in the early 1980s. You could see that red bar coming down. That was the previous worst bond market drawdown in history. But it was very quick. You can see how it snapped right back to new highs. The stock market did something similar. So again, the difference today is that starting point, and the starting point today was close to zero for the bond market in 2020.
So Charlie, I guess in my mind, usually a reason for that bounce back is the flight to safety move. So are we not seeing that? Is there not the sentiment with investors moving in that flight to safety, or are people just so well aware of what's going on with inflation that they know better than to move to bonds? Why aren't we getting that kind of similar? Or is it just different parts of the curve, maybe?
Yeah. So the risk in an inflationary environment is that you're going to have investors behave differently in terms of what they expect and demand from the bond market, and the risk off nature of treasuries. It will come back, but the question is at what level, and we'll talk about that when we get to the Fed. But we're just not there just yet. We talked about the gap between the 10-year treasury and the inflation rate was just untenable, right? Coming into the year, you're talking about the highest inflation in 40 years, and the 10 years sitting below 2%. Like that didn't make sense back then, and now it's starting to make more sense at 4%. And nobody knows where that's going to settle in at, but we're getting closer to the point where that relationship could come back. I think it'll start to come back at the point where people are really worried about the economy, and at that point the Fed is going to change their language and talk about a pause and maybe even a pivot, and at that point you're going to see people rushing to get back into these treasuries, right? Because they're thinking about then the Fed starting to cut rates, and they want to lock in these longer term rates.
So maybe wishing they locked in those 4% yields, right?
Yeah, right. So like the question today is, that I keep getting, I can earn 3% in treasury bills. Why should I go out to 10 years and buy 10-year bond at 4%? What sense does that make? It only makes sense if you think that 3% you're getting in treasury yields is not going to last, right?
Yeah, that reinvestment risk, right?
Correct. Yep.
All right.
And yeah, here we have just illustrating you the worst drawdown ever for the bond market, 26 months. So prior worst was 14 months. So this is now much longer, and it's going to take longer to come out of this to hit new highs, and just given the damage and given where yields are. So when we had those drawdowns in the early 1980s in bonds, yields were in the double digits, and so you can very quickly make your money back when interest rates fall from those levels. And remember that saying, Caleb, there is no alternative? Tina. Yeah. It was like a rallying cry for the bulls for a long, long time. And what they were kind of suggesting, which I called a big lie last year, was that you don't have to worry about equity market valuations because bond yields are so low. And what they were saying is there's no alternative, so just take more risk. And now we've seen uh, that was a kind of a flawed argument, because you were saying that equities are cheap based on an asset class that was at an extreme low in terms of the yield. So even more overvalued asset class, you were saying, making an argument for equities. Regardless, that I think that has been proved wrong. Don't buy stocks just because yields are, bond yields are low. But now you have an alternative for a fixed income investor for the first time in a long time. So we haven't seen treasury bond yields, this many of them above 4%. You got to go back to 2007. So 15 years. So before the financial crisis was the last time you had this many treasury yields above 4% at the same time. And that's good news if you're coming into the bond market today and you're not a risky investor, or you have let's say 20, 30, 40% of your portfolio you want to put in treasury bonds. You could go out and buy them now. And if you hold them, you're going to get 4%. And so for a long time, that bucket was promising you much less, and now you're getting something more. So is it at the rate of inflation? Not yet, no, but much better than it was at the start of the year.
Yeah, and I guess one of the questions I was going to ask when we got here was, I mean, that tight band between the the notes, bills all the way up to the 30-year bonds, right? That flat curve. The reason for that is because that longer duration is appealing because of that reinvestment risk, which we just talked about.
Yeah, and the market's pricing in that recession, right? So that's the inversion that we were talking about in the last webinar, maybe even the one before that. I'm trying to think.
Maybe both.
If we did one, it started. Yeah, the inversion's been going on a long time now, and we talked about the 10-2 spread is predicted every recession, the last 10 recessions, and it's still inverted if we're looking at the 10-2s today. But yes, investors are starting to price in, saying at some point, maybe next year, as we'll talk about in a little bit, they're going to start cutting rates. And when that happens, the investor behavior, when the expectation is that investors go out on the curve, they buy longer duration treasuries to lock in that rate on the expectation that those short-term rates are going to fall. And here's the good news for investors in bonds today. This single best predictor of future bond returns is just very simple. What is that starting yield? Bond math is much, much simpler than stock math. Stock math, you have to predict what is the valuation going to be in the future. Almost impossible to do that. And that's why predicting stock returns is very, very difficult. Predicting bond returns in the short run, very hard, because it's all interest rate driven. As we've seen this year, the direction of interest rates determine everything in the short run. But if you go out 5, 6, 7 years, you see a very high correlation between that return over that entire period and that starting yield. So we entered the year in that 10th decile. In 2020, we were below that. We were at 30 basis points on the 10-year, which was predicting essentially 7-year returns of nothing. From that 2020 period, and I think that's what'll actually happen when all is said and done. But now we're getting close to that 8th decile, which means if you hold bonds for the next 7 years and you're not trading it, you should get 4 to 4.5% would be a reasonable expectation. Maybe 5%. If interest rates go down, you can earn more during that period of time. But I think that's a reasonable expectation, which is that 40 part of the 60-40 is looking better than it has in 15 years.
All right. So worst year in history for bonds, but there's some good news.
Great news if you're coming into the bond market today, or if you still have those bonds, the damage is done, and your forward returns are going to be better. But yeah, here's the big one, Caleb. This is the
let's talk about the housing market. We do have a couple questions coming in about the Fed. We'll get to that next, but let's spend some time talking about the very exciting topic of this weird housing market.
Yeah, the housing. And we got another print today, and I threw this chart in here. So we got a real-time update. 6.9% mortgage rate in the U.S., highest in 20 years. So that's pretty long period of time. And the big thing, of course, is where we started from. And so in early 2021, we hit an all-time low in the 30-year of 2.65%. So that's a huge change, and we'll talk about what that means for the home buyer, the average home buyer, on the next slide here. But we just haven't seen such a rapid increase in terms of the mortgage rate since the early 1980s, and so this is a situation that is going to resolve itself in one of two ways. So you have a combination of higher interest rates and higher home prices, which is making housing unaffordable. And this chart is just showing you simply what's the median housing payment you would need to buy the median home as a percentage of your income, right? And you don't want to see this going up because that means housing is unaffordable. And when it reaches the level it's at today, which is, we only have data going back to 2006, but that was the peak of the last housing market. You could see the 42% there. It just makes the demand side collapse. The lenders aren't going to lend to you if this is if you're going to be spending 40 something percent of your income on a home price, and you're not likely to want to buy that anyway. So you have what you have is, as a result of this initially, is what you see is what we've been seeing all year is transactions collapse. So buyers go away, sellers don't want to budge yet. They're still anchored to that recent home price. They're talking about, oh, my neighbor sold their house, last year for X amount, and they sold it a few months ago for X amount, but they're not recognizing that the game has changed because of this affordability collapse. And the next chart really illustrates what happens in the first stage, which is transactions just plummet. And we've seen this in new home sales. We've seen this, and this is a chart showing you existing home sales, and lowest since 2020. And that was just for a few months during the initial period during COVID, where everything was shut down and no one was doing anything. That quickly came right back, and we had just a booming housing market, of course. And now, if you exclude that period, you got to go back quite some time to see transactions go down this much. And so that's stage one. Stage two, of course, with a little bit of a lag, and we're just entering that phase now, is prices have to come down. If demand is collapsing, even if supply stays the same, which it's not, it's slowly starting to increase, you're going to see prices have to come down to meet that demand. So there's still plenty of people who want to buy a home today. It's just the price is too high.
Sure.
And so we had a good run. It's 126 consecutive monthly increases in home prices in the U.S. Record highs, every single month in recent years. And as we talked about during 2020 and 2021, just these gains accelerated to the point that we were looking at the second major housing bubble in U.S. history. And just with the last reading, we saw the first decline since December 2000 to 2011.
Which, small decline. Going back to that chart you had, a couple pictures ago. Yeah, I heard that explained another way, which was really kind of eye-opening for me. If you go back to 2020 and the same house that you would purchase, or any comparable purchase, essentially for every $1,000 mortgage payment you would have had then, you now have $1,800. So 80% more.
Yeah.
That you're paying each month to live in the same home. It's crazy.
Right. And so needless to say, people aren't making that much more in income over that period of time. So that's, the math very quickly doesn't work when you have that type. And with the recent increase in mortgage rate, the math just gets worse and worse. And so you have one of two ways this can rectify itself. One would be mortgage rates come right back down. They might come back down. Are they going to come all the way back down very quickly? Probably not. The second way would be the more likely way: housing becomes affordable again, which is what happened after 2006, 2007 peak, is prices came down. Back then, nationally, we saw about 25% decrease. You had certain markets down 50% or more. If you looked at Miami or Phoenix, Las Vegas, not really the hottest markets. So that wouldn't be unexpected or surprising, I think, to see something similar. We could see more, we could see less, but even if we came down 25%, that affordability would still be probably problematic for a lot of people. So
Charlie, do you
It's going
expect
to be
the impact of a crash like that to be a little bit more subdued though, because there aren't as many bad loans and a lot of people that did lock in their mortgage rates, at or below 3% still have a very affordable payment when they don't really have an alternative to that.
Yeah, so I guess we could talk about the impact of, is it going to be similar to the subprime crisis that we saw? No, every time is different and doesn't appear to be the same lending standards problem that we had back then. We just had here a manipulated mortgage rate, unfortunately, and that, to me, that was the biggest policy mistake the Fed could have made. And this is in hindsight saying this. Many people were arguing this. You have housing prices already at bubble levels, and you're pushing mortgage rates down to all-time lows. No need to do that. So it's going to be a hit to the economy. Housing, people, it tends to be people's biggest asset. So when they see their housing price going up, they tend to spend a little bit more. When they see it going down, they tend to spend a little less. Obviously, if they're not moving or buying new homes, there's less furniture sales, appliance sales, right? So there's a secondary effects there. We benefited, of course, from all of that the past few years, and now we're going to be seeing the opposite. So it's going to be a hit to the broad economy. I don't think there's any way around it. But you're right. If you're in your home for the next 20 years and you're locked in at 3% or below, should you worry about the price going down 20%? Probably not. What can you do about it? I mean, it's like you could sell, but you have to move somewhere else. There's not too much someone should do about it or worry about it, right? As long as they have a fixed rate mortgage. If you have an adjustable rate mortgage that you got a few years ago, maybe you have some time before it resets, but there you got to be hoping that rate is going to come back down before you get that bump up, because that's sure. We haven't seen the problems from that yet, Caleb, and so we'll hopefully that's not too much of a problem.
All right, let's talk about the Fed.
Yeah, so you're not supposed to say this time is different, but this time is a little bit different in terms of the Fed's behavior, and this wasn't exactly a surprise because the Fed made it clear that they had to start normalizing interest rates. As we talked about, they were so far behind the curve entering this year at 0% when you had inflation really spiking starting in May of 2021, and they held off for a long time. And so the past bear markets going back to 87, you always had the Fed cutting rates and doing QE and coming in to save the day. And you hear the Fed saying we're not going to do that just yet because inflation's the bigger problem. So for the first time that I could remember, I actually agree with what the Fed is saying in that they're following their mandate and they're taking inflation seriously because they know how bad it can be. And we've seen this throughout history. If you let inflation run away and you ignore it, in the short term, that's going to feel good. In the long term, it's going to be very, very bad for people. And so different policy response. Of course, the markets are not exactly happy about that for now, right? In the long term, it probably be actually a good thing. But for now, the market's not taking this very well. The news that the Fed is going to continue normalizing rates.
And I guess we had another print of CPI today, right? And maybe that kind of ties into what's happening and why the Fed's hiking rates. But how did you interpret today's number?
Yeah, it came in a little bit higher than expected, but not a huge shock. What the interesting thing in there is that a lot of the CPI data is a little bit wacky. Particularly the housing component, the shelter component, and it's really been understating the true rate of housing inflation over the past few years, and now it's playing catch up and starting to move higher, and that's pushing that core rate of inflation up. And what's interesting is as we saw, housing prices are now starting to come down. Rent increases are actually slowing significantly, and I think they'll likely continue to slow. But the CPI, at least that component, is a lagging indicator of that. But the markets are smart enough to parse that out, and the Fed, for now, they're as they should are viewing this chart as more important than the stock market declines and the declines we've seen in financial markets and the hit to the economy is that people workers they're not able to keep pace with inflation in terms of their wages, and so how do you balance this out? You have to bring that inflation rate down. So you're having 18 consecutive months. This is going to continue the next few months, but by hiking interest rates, it's going to curb demand. It's already doing that. We're seeing a number of areas starting to come down. Used car prices is something we talked about, that crazy bubble. It's finally looking like it's starting to deflate there. Prices are down year over year for the first time in a while. If we're looking at used car prices, we're seeing other areas as well. We're seeing that demand supply equation start to even out. And so a lot of people, Caleb, are complaining about the Fed now. It's very interesting. They're calling this a policy mistake. They're saying they're going too much, too fast. Can't they see that inflation's already starting to come down? Of course they can see that. And what's interesting is these same people never talked about the policy mistakes of keeping rates at zero for so long, of buying mortgage bonds during a housing bubble, and of doing what they did to the money supply, which is increasing at 40% over a 2-year period. If you're going to talk about a policy mistake, that's why we're in the situation we're in. And it's not a mistake to try to bring down the rate of inflation. That's their mandate. It's literally in their mandate. Price stability and maximum employment. We saw the unemployment chart. Can't go much lower than that. So they have to worry about, for now, that price stability and trying to bring it down. So, I've given the Fed my fair share of criticism. I don't believe, as you know, that 12 people sitting in an ivory tower should be determining what the interest rate should be. The market should be determining that, as we've seen. But right for now, they're doing the right thing, even though it's going to be hard and painful in the short run.
And I've been doing these webinars with you for a couple of years, Charlie. It's the first time I've heard you take their side. So I can vouch for your typical nature and where that's at now. But I guess
I gotta I gotta give credit where credit is due, and not that this is giving them, it's just doing their job, right? If your job is to control inflation, and inflation's at a 40-year high, then do your job. Okay, so let's talk about the road back to normal. Right? It's been 300 basis points of hikes so far this year, and the last few 75 each, pretty steep, and the market is expecting another 75 in November, so just a few weeks. And then 50 in December, and then 25 in February. So the market's predicting the Fed is going to react sometime in the next few months to likely more evidence of an economic slowdown, whether it's the labor market shows its colors, or we have more the housing downturn really starts to show up in the data. Any number of factors you can point to. The Fed is not going to, in my mind, continue to hike rates at 75 basis points, over the next year, right? At some point, it's going to end. The market's saying it's going to end in November. We'll see if that's right, but it's at least one more big hike, and then, in my view, you'll probably have additional evidence that CPI is coming down, and the Fed can start to at least slow down and then pivot. At that point, they don't want to do. I don't think all of a sudden this is Volcker and they're going to push rates up to 20%. And I'm not sure they need to go that high this time around either. So at any chance, I think they want to calm the markets, and even though I believe we're in a recession, they're not going to want to deepen the recession any more than they have to.
Certainly heard Volcker's name more in the last few months than I had in a long time, though.
That's right. And then the balance sheet, right? We forget about this, but the Fed added quite a few billion dollars to their balance sheet during 2020 and 2021, and now we're just starting to move in that opposite direction. So you talked about that safety bid, and why isn't it there? Well, some of it might be that the Fed isn't there anymore to be part of that bid. And obviously, this is impacting the mortgage market as well, in terms of you just don't have that constant buyer to support the rates. And this is expected to continue, right? So we're just starting to see an accelerated pace of reduction. Now it's expected to be 95 billion a month going forward, which would be an increase. So far, it's been pretty slow. But remember, we had trillions in the past few years. And look, if the stock market decline gets too much and the economy gets too bad, they'll pivot on this as well and likely start buying again. But we're not there. We're not there yet.
And, if you rewind, I guess maybe a year and a half, 2 years ago, everybody was hoping for that V-shaped recovery. Then you heard about the K-shape, whatever. Now everybody's hoping for a soft landing, right? Is that?
Yeah, that's the
possible?
that's the Fed speak. That's the hope. They don't want to use the R word. I don't think it's possible based on history. If we look back at history, anytime CPI has been above 5% and the Fed has hiked rates to try to bring it down, there was a recession, and the recession was part of the reason why it came down. You had that demand side come down, prices came down, and that was the result. So you'd have to be pretty optimistic here to say we're going to avoid that outcome. Yield curve is showing it. The housing market is showing it. Any number of leading indicators are showing that a recession, if it's not here, it's coming soon. And we have the 2 consecutive negative real GDP prints already. So no, it's going to be a hard landing. Hopefully not too hard. And as you can see by those gray bars, recessions can last long. They can be short. They're all different types of magnitude. So none of that is predictable. But the notion that you can do what we did in terms of the money supply and the fiscal stimulus, and then pull that back and try to rein in the effects of that, which is high inflation, without taking some pain. I don't, it's just not possible. And that's okay. Like as a country, we should agree that we sometimes have to take pain. And this is one of those times for the greater good of long-term stability, prosperity. Any country that's had super high inflation for years on end has not been good for anyone. And so I hope that they don't have to push it so it's the recession is too deep and there's too much, but there has to be some pain, and we're all going to feel it. We're all already feeling it. And if we don't want our kids and our grandchildren to feel the pain of hyperinflation, then we have to take some short-term pain.
Sure. All right. Before we shift away from the Fed, we'll take I think kind of a fun question, which is, do you see a time in the future when the, Federal Reserve Committee is not the one that controls the Fed funds rate, instead it's driven by the markets?
Gosh, I hope so. It's pretty remarkable to me that all of these Western democracies and that pride themselves on free markets and not central planning are still doing it. And so I think I think someone, maybe it won't be the U.S., but someone at some point will go to a more, even if they don't want to let the market do it entirely, that they would go to a more systematic type of thing where we have so much data today, Caleb, like, that every business is becoming a data business, and we have real-time data. Why is the Fed looking at lagging data? Inflation is already coming down, as people talked about, and as people talk about. So why are they using that kind of data and not real-time data in terms of home prices, rents, other inputs, commodity prices? But the bigger question is, why do we think that people subjectively can get that correct, given the evidence that they can? Like, there's always going to be political influence, even though they're not supposed to be. There's always going to be just the temptation to have easy money, because in the short run, that's better, right, for everyone. It seems better. And so, like, human beings will have that bias. But to me, it would be better just to have, let's say, 3% rate and leave it there forever and just don't do crazy things with the money supply, that would be preferable to this cutting and hiking and everybody worried about which direction the next, that would be a better policy, because at least you can count on that. Money needs to have a cost. I'm not a big believer in 0% rates, and I think negative rates are ridiculous. We didn't talk about that today, but finally Europe is abandoning their negative rate policy. Switzerland, Denmark, ECB, after the experiment has gone bad, they finally now are moving back to positive interest rates. So I'm not optimistic that it's going to happen anytime soon, because the Fed is in power, and this is a lot of power. You make a lot of money when you leave the Fed and you do speeches, as you might know. So it's a pretty good gig. I don't know what kind of information they're giving these people to earn that kind of money as consultants or after they leave the Fed, but it's a pretty good gig. So it'll have to come from Congress. Congress will, in my view, should take away that ability. Not that I don't want Congress legislating interest rates either, because they're not going to do any better. They're going to, again, it's going to be politically motivated, and then they're going to try to get reelected. If their party's in power, they're gonna do what they can to be reelected. So why not just have a market? Why not have a market-based system that's based, and not try to control a $25 trillion economy with 12 people sitting in a room, because they can't get it right. And we don't do it with food. We don't do it with other goods. We don't have the Fed say, like, how many bananas should we have this year? How much this, right? And it works itself out, right? Like, we've done a good job with that stuff. So anyway, I'll get off my soapbox.
All right, we'll move on. We'll move on to our last section here. Hopefully everybody's had a chance to fill out this poll question, though. So maybe we can.
Are you going to vote here, Caleb?
I don't think I'm allowed to, but
maybe
I can vote out loud.
Okay. Yeah, I can't vote either. Okay. All right.
See if we can advance the slide, and then I think Alex, we can wrap up that poll for us. There we go.
All right, so there's a little bit of fear. Probably it's probably not surprising after the topics that we covered, and there's a lot of reasons why people are nervous today. I had to fill up that whole kind of box there of why stocks are falling, inflation,
you ran out of
rates.
Room.
Yeah, I need a bigger chart. We got a threat of nuclear war, hopefully doesn't happen, and recession fears, right? Because we haven't had an official recession. So many number of reasons why people are very fearful today. And we've had now this is the biggest correction, Caleb, that we've seen since the March 2009 low. So a year ago, we were having a webinar talking about the buy the dip generation. Remember that?
I do, yeah.
Good time. Yeah, where every dip was short-lived, and you just come in and buy it, and a few weeks later you're back at new highs, right? Including that, that sizable dip, 35% back in February and March of 2020, right? But this time is a little bit different. It's a 9-month bear market so far, and we'll see how long that it lasts, but that mentality is kind of breaking, and now you're starting to see fear for the first time in a long time. And here we go. This is the AAII. They poll people every week. They're asking the same question that we asked you. This market, are you bullish, neutral, or bearish over the next 6 months? And as you can see, recently we hit the lowest level, if we're taking the spread between bulls and bears, lowest level that we've seen with data going back to 87 in this index that we've seen, with the exception of 2 periods: October 1990, which was the low of that bear market, and March 2009, the week of the lows of that bear market. So it was a little bit lower in both of those instances, but people are safe to say people are pretty fearful today.
Let's see how this compared to our results, if we could.
Yeah.
There we go. Oh.
Okay. Definitely not as.
No, that spread's a lot smaller. Was that 9%?
Yeah.
So 11%?
Yeah, 11% looks like the spread. Very interesting. So we have an optimistic group. Maybe it's because
Maybe it's because you were
these
talking
they're
up the Fed's policy now.
talking up the Fed, right? Yes, or a lot of contrarians. Anyway, in any case, I like to see it, and the next chart will illustrate why I like to see people a little bit more bullish than perhaps that AAI poll. And here it is that on average, and these are just averages, it's been better to be greedy when others are fearful, as Buffett said in that quote below. And what this chart just illustrates, the first row there is how the market has done going forward 3 months through 5 years when you've been in the bottom 3% of those readings. And we're certainly in that area today versus the top 3 in all readings. So as you can see, above average performance going forward on average when you have sentiment extremely fearful. When investors are very greedy, you tend to see the opposite, much below even negative average performance. And so the odds would suggest better returns ahead. Now, the question I always get from this is it every time? And the answer is very much no. And the notable exception to this, these averages happened in 2008 when investor sentiment was pretty bad early on that year with Bear Stearns. And then it continued to get worse. And so the short-term returns from there, not very good back in 2008. And even this year, we've seen kind of persistent negative sentiment. This is just the lowest that we've seen so far. So in the short run, anything could happen. But all else equal, if you're an investor, you'd much rather be buying when other investors are very fearful than when they're greedy. Yeah, and this kind of tells you why that's the case. It's the upside of downside, as we talked about in the last webinar. And now we have even better future upside because yields have gone up. So if you're a treasury bill investor, this is as of the end of September. It's even higher now. We're looking at 370, I think, on the 3-month. So anyone who's doesn't have a high yield savings account, go out there and open it up. So there's a lot of inertia with that period of 0% interest rates where it really didn't matter. But now you can earn 3% risk-free, FDIC insured, up to $250,000 per individual. And so if you're not planning on investing that money for the long term, and you're just saving that for an emergency or just to have just save for a house or other things, you can link to your checking account and earn 3% first time in 15 years. And that's going to go up too, right? When the Fed hikes another 75 basis points in November, you'll be getting at some banks 4% on your money, just sitting in a savings account. And 10-year Treasury, much better. So if you're a longer term bond investor, your future returns that we talk about has gone up. Investment grade bonds, gosh, I think last year we had a webinar where we were talking about the lowest level in history there for that and high yield bonds. High yield bonds are actually below 4% last year, which is kind of remarkable because we're about to have treasury bills at 4%. So now you can take no risk and get 4%. And just last year, you have to take very high risk to get 4%. So better there. REITs, prices of REITs, real estate investment trusts, have gone down. Yields obviously gone up, and the S&P dividend yields a little bit higher. Valuations have come down. So across the board, cash flowing assets, better risk reward today than they were at the start of the year.
That's Charlie, one that you don't have listed here that I've heard a lot of chatter about, munis and tax equivalent yields of upward of 5 to 7%.
Yeah, finally, right. Yeah, which is what a remarkable turnaround, because it wasn't that long ago in 2020 that munis, the tax equivalent yield was, there was so much demand for munis. The tax equivalent yields, the first time I saw this back then, was lower than comparable. It made no sense to buy munis, and now you're finally again being paid to take that risk. And there's some obviously risk in munis, and there's duration risk, of course. But yes, if you're a long-term muni bond investor, you should be very excited today. And This is good news as well. I just looked at the Wilshire 5000. That's the broadest U.S. equity index, so not just the S&P 500, which is the 500 largest stocks. It also includes mid caps, small caps. If you looked at the worst 9-month returns going back to 1971 here, and we looked at future returns, as you could see, in the short run, anything can happen. 3 month, 6 month, who knows? As you start to go out further, the odds of a positive return go up significantly, and the outperformance is pretty solid there as well. So no guarantee that anything can happen in the next few months. Absolutely no one should be surprised, Caleb, if this 28% bear market turns into 30 or 40 or even 50, because we've seen it before. And look, there's enough bad news to get us there. But if you're looking back at history, when we've been down this much, if you're adding to your IRA or 401k every couple of weeks, now's a much better time to do that. And if you're looking out 10 years or more, which you should be as an equity investor, everyone's hyper focused on what's going to happen next week or next month, but equities are long duration instruments. You got to be a long-term investor, as we've seen why this year. You should be feeling much better about the situation. And for every tick lower, that statement will only improve, right? So the news will get worse if we're down 30, 40, 50%, but future returns will be much better.
All right. Well, I didn't get to answer the poll, but I think after hearing all your optimism, Charlie, I'm bullish again. So
good. Yeah, we'll change that 6 months.
Maybe not over the next 6 months, but in general. Do you have time for a couple questions here?
Yeah, let's do it.
We've got a lot. I kind of lost track of questions as we were going, so I'll grab a couple here, and then we'll do our best to answer everything that we don't get to live offline. But I know I saw a question about how you feel about supply side stimulus and that being an option as opposed to keeping or lowering rates
in terms of
as a way to keep us out of a recession. So I think maybe targeting to lower energy prices or keep the supply chain a little bit more.
Oh, supply chain. Okay. In terms of solving the inflation picture.
Yeah, exactly.
Okay. Yeah, that's working itself out. And no, I'm totally in favor of increasing energy production, increasing housing supply, all the rest of it. The market should determine that to some extent, but we could, on a policy side, we should certainly be doing as much as we can there. And every week I tweet out a chart of freight rates globally, so just shipping costs. That's coming down significantly. So supply chain issues are easing in part because people are coming back to the labor force, which is a good thing, and they're coming back in part because inflation's so high they need to work again, and the stimulus money has run out, and that's helping. And every month that goes by, I think that'll continue to rectify itself. But the people have argued that we can just solve it on the supply end, that the demand end or the money supply end we could kind of ignore. I don't think that's I don't agree with that. I think it's not happening quick enough. And the normalizing interest rates, that's all we've done so far, is normalize interest rates, is doing its job in at least curbing demand. And there's still plenty of demand, as you can see. There's still people spending money. They're still traveling. Travel numbers are still pretty strong, and retail sales haven't plummeted just yet. And we talked about the reason for that in the last webinar, but that's kind of continued with savings rates coming down and people are borrowing more. But no, the Fed, we have to take the pain, and the Fed has to hike interest rates because the demand side is not nothing. And so it is one part of it, but the people arguing that hiking rates isn't doing anything for inflation, I don't think they're being objective. It definitely is. And the money supply also. We didn't talk about the money supply today, but for the first time in 20 years, money supply growth over the last 5 months has been flat to down. So I think they've gotten the message that we have to slow down here.
Yeah.
And we don't need any more on that end. And so the more they do that, the more I'm optimistic that the inflation rate will come down.
What about the dollar? the strong dollar has been another big topic, a lot of questions there.
Yeah.
How do you see that impacting the go forward strategy and the
Yeah,
Fed?
the dollar's move has been incredible, and what I'll always say is the dollar is just relative, and so uh, the ECB's policy and the Bank of Japan policy, those are the two biggest components of the dollar index, the yen and the euro, and their policies have been easier, right? And for now, the market's still expecting the Fed to be more aggressive in tightening than those central banks. But at a certain point, that'll shift, and I think we're getting closer to that, certainly in Europe, where they're having significant problems. There's a lot of pressure to hike rates faster in Europe, and I think that the minute that happens, you'll see obviously a dollar come in, and so I have no predictions on the currency side, but I think we're at the point now where the dollar is extremely extended to the upside. I would not be surprised to see it come in given the expectations, right? And that's all relative. And if we're looking at if we're looking at the impact of the dollar on earnings, we're going to soon find out. As we've talked about, I expect it to be just an additional headwind, and it's hard to quantify exactly what it is, but it's at least a few percent. If we're looking at these multinational corporations that strengthen the dollar when they bring it back to the U.S. Overseas tends to be a hit on earnings for those companies. So yeah, it's just another headwind that I guess we didn't need, but it's here and it'll normalize itself. Global
Sure.
currency market is very, very liquid, and when it goes too much in one direction, it'll go back in the other.
All right, Charlie, there's more questions, but I know we're kind of way over the time that most people set aside for this today. So we'll try to take some of those offline. Did want to mention, as usual, right, your blog posts, charts are available there. Anybody that wants to use these to talk to their clients or have these conversations kind of outside of, YCharts, I think you've always been very willing to share your content in that way, right?
Yeah, absolutely. That's the goal of what we're doing here today. That's the goal of putting out this data and information every day, is just to help investors make better decisions as much as possible. So yeah, feel free, if they're helpful to you or your friends or your clients, feel free to use the visuals. And yeah.
Great. Well, thank you. Do you want to pick an S&P 500 bottom before we sign off?
Absolutely not.
All right, Charlie. Well, thank you so much for the time. Look forward to doing this again soon. And, just always enjoy it. So thank you.
Awesome, Caleb. Same here. Thanks everyone for joining. We'll see you.
All right.
We'll see you
Bye,
soon.
everybody.